and good afternoon. Welcome to this live webinar, which is titled Optimism, what most fund managers want to avoid talking about, but should. This is a 50-minute programme brought to you by Citywire and the team behind the Baillie Gifford Managed Fund. My name is Amy Maxwell, I'm from Citywire, and I'll be presenting today's broadcast. Today we'll be joined by our guests, Iain McCombie and Stephen Hay, co-managers of the Baillie Gifford Managed Fund. Stephen is also head of income research at the group, and Iain is a partner and investment manager on the UK equities team. They'll be giving us an update on some exciting new positions in the portfolio, as well as providing insight into more established holdings. I'm really looking forward to hearing how Iain and Stephen have navigated some pretty unusual market dynamics and hearing why they are so optimistic about the future of the fund. A little bit more about how we're going to run today's session. Firstly, I'm going to interview the managers, and then we'll be putting your questions to them in the Q&A session. If you have a question for Iain or Stephen, you can submit it at any time via the Q&A box in Zoom. Okay, welcome gentlemen. Thank you for joining me this afternoon.
Afternoon.
So I'm going to start, Iain, with you. It's been said that the managed fund is Baillie Gifford's best kept secret, running since 1987 and outperforming its benchmark after fees. So let's kick off with an explanation of what's driven those 34 years of stellar growth.
Yeah, well, Amy, I think the kind of key thing, as you say, is the fact that it's been run pretty much the same way for 34 years. So what is the secret sauce of that? And one of the things is that we keep it relatively simple, that the fund invests in equity, bonds and cash, and that's it. But I think, to go beyond that, it's how we invest the money. And I think there are kind of three key points: that we're active. So our portfolio looks very different from the benchmark, because we think to outperform, you've got to be different from the index. And then we're growth investors. So we're trying to find companies that are going to grow their earnings and cash flows above average over the long term, because we think that the market will reward that. And the last thing is that we're long term, that we try to turn the market's kind of short termism to our advantage by owning companies which have got great growth potential for a long period of time. And then, as you said, it's after fees. And the last point, I think, is that the all-in costs of the managed fund is only 43 basis points. So it's got great, I think, long-term investment success, but also low cost, which I think is an attractive proposition for holders.
And 34 years is a long time, and you've seen a lot during that time. I mean, you also launched 6 months before Black Monday in 87, so you really have seen it all.
Yeah, well, you certainly can't accuse us of being market timers, given the fact we launched it just before the market had a famous crash. But I think that's a really important point, though, Amy, is that the 34 years, we've seen lots of things. It's been there, it's got the T-shirt, this fund. And what we've found is that to get long-term success is to stick to your knitting, keep doing what you always do, and try not to get distracted by all these crashes and worries about recessions or currency and so on. We've been there, and actually what we find is successful is sticking to that approach.
And have you found, 2020 was a very unusual year. We all recognise that with the pandemic. Has there been any, can you give us a flavour of how you've stuck to your guns and how you've navigated that situation?
Well, actually, it's a good example of actually being long-term, is because our portfolio turnover remained pretty low. So actually, one thing is we didn't do very much, which may sound a little bit counterintuitive, but the reason for that was that actually a lot of the companies and a lot of the themes, I suppose, we are playing into, the growing digitalization of the economy, it got a massive turbo boost through the pandemic. So actually, companies that we've been talking about for a long period of time started to come through very nicely in 2020. So why would you do anything about it? You keep owning them.
Excellent. Okay, Stephen, over to you. We've got a lot of people tuned into this webinar this afternoon. How would you describe the makeup of your client base? What are the potential investors looking for in this fund?
Yeah, well, I think it's a really diverse investment base we have, and it's really quite interesting. So we have everybody invested in the managed fund, from individual investors through wealth managers, IFAs, and we actually have quite a few institutional clients as well in the managed fund, and that's really quite unusual. A lot of other funds at Baillie Gifford are either individual investors or institutional. The managed fund really does span a huge range of different clients, and I think it's partly down to the longevity of the fund. It's just been around for so long that people have heard about it over different periods for different reasons, and they've seen the performance over that length of time, and they've been attracted to it. And so very diverse. And I think what draws it together is that it's providing something for a lot of different people, and what that is you're overwhelmingly getting access to the best of Baillie Gifford's growth equity ideas. So, we run with a strategic weight of about 75% in equities. And so that's the real biggest driver of returns in the portfolio. And that's fairly consistently so. So people are recognizing that that's what they're getting, and access to, growth in the world economy, and that's coming through. But it is balanced. So people, some people don't want just the equities and the volatility that might come with that. So we provide the balance by having bonds and cash in the portfolio, so the returns are not as volatile as you get from a pure equity portfolio. So I think that's attractive to people, and they also know that we are doing some asset allocation in the fund. So if we really think that bonds are unattractive, we'll have less money in bonds than we would typically have. So we are doing active asset allocation, which takes that job and that kind of concern away from people. So a whole bunch of reasons, a whole range of different investors, many of them who have been with the fund for decades. So really interesting to chat to them at conferences and such like, and get a flavour for how it appeals across lots of different sectors.
Now, I want to stay on that, the makeup of the fund, and particularly the bond allocation, which is your area of expertise, Stephen. Given we're in an era of ultra-low bond yields, and we have been for some time now, is this sleeve still relevant? I saw a stat recently stating that 75% of the global bond market pays a yield of less than 1%. So given the market dynamics, are you still able to find really interesting ideas here, or is that getting harder for you?
Absolutely right, Amy. The low yields do provide more of a challenge. It's not as great a backdrop for bonds as higher yields. And your stat is absolutely right. And I think it highlights why you have to be an active investor in bonds as well as equities. So, you mentioned that 75% of the index or a neutral bond universe is less than 1%. So whereas in our fund, we have almost 40% of the bond portfolio that is yielding over 3%. So these are still not hugely high yields by comparison to the past, but it's much more attractive than sub 1% yield. So and we have over 60% that is yielding over 2%. So we are still finding opportunities and some really attractive ideas, particularly in the corporate space. And yes, I suppose we do have to work harder to find those great active investments that we want to put in the portfolio. Let me give you one example to give you a flavour. So, Netflix company everyone's familiar with, and indeed we hold in the equity portfolio because we like the equity story, but we've also liked the bond story. So when Netflix first came to the bond market 4 or 5 years ago, they were in the phase of really increasing content. So they had to borrow to fund that content expansion. And so they came to the market with a bond which was rated in high yield. It was rated single B. We bought in at that point, and our investment case was that initial investment in content, and they would see subscribers and revenues increase, and they would be able to deleverage over time. And that's exactly what you've seen happen. So it was accelerated by the pandemic, but they have turned cash flow positive, and they're starting to delever their portfolio. And what that means from a bond perspective is that it gets upgraded to the higher credit quality, and the bond price goes up. And you can make additional returns for our clients from that, even though the overall level of bond yields is still quite low. There are plenty of individual stories, and I'll just pick out another one on the developed market government side. It's not all about gilt yields that are 1%. There are other countries in the world that we can lend to. Australia is a country where yields are significantly higher, where it's a much more solid macroeconomic backdrop, and where the return prospects for bonds is good, but lots of stability, which is what we want from our bond portfolio as well. So we are finding opportunities also in emerging markets. A country like Peru, we are able to lend to with confidence. And it's not all emerging markets by any means, but we can find specific ones that we think offer attractive yields and fit into the portfolio. And all the time, we're remembering that the bonds provide the balance in the portfolio. So that's a really important role that they're playing alongside the equities.
So you're really seeming to get that sweet spot of growth as well as that attractive yield. What I know that this webinar is all about optimism. So I'm just going to throw, and I know this fund isn't, you're not going to get a strong macro view from this fund, but Stephen, staying on the bond issue, inflation. Lots of people are scratching their heads about it. How worried should they be, and how is it impacting your management of the fund here?
Yeah, Amy, I mean, the inflation is very, very interesting to me. I'm an ex-Bank of England economist. That's my background. I'm looking at fixed income. Of course, inflation is important to me. And we do talk about it a lot, and the chances of it being higher. Personal view, I think there are cyclical reasons why we are seeing a very strong inflationary dynamic at the moment. A lot of stimulus being thrown at the economy, fiscal and monetary. I think there are structural reasons too why inflation could be a bit higher over the future. The pandemic and climate change are reasons why government spending will remain high. I think globalization is being reduced, and I think that will affect it. And I think the demographics are also a little bit less positive. And I think the central banks may find it harder to control inflation than in the past. But for all that I have views and thoughts, it's very important to recognise that within the managed fund context, the managed fund has seen bouts of inflation before, it's seen market crises before. And so the important point is that we have the investment flexibility to deal with lots of different macro outcomes. And what we spend our time doing is not so much debating the exact inflation outlook, it's debating the individual investment stories on both the equity and the bond side to make sure they are really good investments for our clients. And yes, we will be asking the question of whether they are robust to a higher inflation outlook. And so when Iain looks at these companies, then pricing power, for example, is something that is important. So if there is inflation, can the company raise prices to keep pace with that? It's a really important aspect to things. On the bond side, we are doing something. So from an asset allocation point of view, and we've discussed with Iain, bonds are a little bit less attractive because of the higher inflation risk. So we have a reduced proportion of the fund in bonds at the moment to reflect that. So that's one of the things we've been doing. We've also been buying shorter dated bonds, so we have less responsiveness to yields rising in the fund. And also we are overweight in corporate bonds in the high yield segment. And actually for high yield companies, they're more indebted. A little bit of inflation is actually quite a good thing in terms of helping to erode their debt. So we're finding areas that are interesting. We've bought some inflation-linked bonds in the portfolio just so we can help protect it in that side. So there are things we can do within the portfolio to help guard against that higher inflation scenario. But the overriding message I think I would like to leave is that the managed fund's seen all this before. We can deal with whatever macro environment comes along. And it's not something that we spend every minute of every day agonising over. We're much more focused on the individual investment stories.
Well, it certainly sounds like all the bases are covered there. Now, let's move on to the equity sleeve. Iain, it's been well publicised that Baillie Gifford as a house has been enthusiastic backers of Tesla. And the managed fund is no exception. You hold it, if you can call it, well, it's a car maker, if you can call it just that. But it's had a very strong 2020, delivering 500,000 vehicles. I understand, however, you have reduced your positions a few times in recent months. So what is the rationale behind this? It's what everybody wants to talk about. So let's just touch upon your latest moves there.
Sure. I mean, Amy, if we'd gone back, I would say 18 months ago, I think people were saying to us, why on earth do you own Tesla? You must be lunatics. And actually, this kind of goes to the heart of the optimism that we were talking about. That it was very easy to find the negative case for Tesla, but actually, what we said was, well, what is the optimistic case here? And people were saying, oh, they can't grow, they can't make 500,000 cars. But actually, we thought actually they do have that capability. So, but what we're trying to do in terms of our investment process, and why your question of why have we reduced it. Well, one thing is the share price has performed, phenomenally well. But what we don't just sit there and say, well, isn't that great? We then say, well, can we still see upside from here, or where does the upside, stem from here? And in the case of Tesla, we still see a lot of positives. we can still, it's changed this industry. I mean, again, 2 or 3 years ago, if you talked about, half the cars, being electric, you probably would have been sort of sounding a bit like a lunatic. The fact that the Tesla is the best-selling car in the UK now, again, that would have been seen as fantastic a few years ago. That is the reality today. But what we've got to say is that the fact that the share price has performed so well, is there the same upside as there is today as there was a couple of years ago? And the answer is no. So that's why we reduced it. But it's not just Tesla there. It's things like Amazon. We've done the same thing. We've reduced it recently after having very good performance. In the last 12 months, we sold out of Alphabet and Facebook. So it's very much our investment process that we don't fall in love with our stocks. We have to look at the upside, and we don't no longer see the upside. Either we will reduce it or we'll sell it.
Okay. Another techie stock, Zoom. Amazingly, I mean, this I found is an amazing story. You bought in the final quarter of 2019, but just before the pandemic hit. So how was that for timing? Given its rise, are you still confident again that it has a pathway to growth?
Yeah. Well, first thing, Amy, is that was luck. Okay, there was no brilliance of predicting the pandemic or anything, but it was interesting because before we bought it, I'm sure like yourselves, we used to have video conferencing and it was terrible, and then we had internally at Baillie Gifford, we introduced Zoom, and I actually remember it was Stephen and I, we had to have a call at short notice, and I think I was for some reason in Canada, and Stephen was in Glasgow, and with colleagues in Edinburgh, and somebody was in Asia, and I thought, this is never going to work. This is going to be a complete disaster. And it worked. It worked really brilliantly. And I think we were all so surprised. And I thought, well, this is really quite a good product. And we'd already been doing the work in it, so we bought it. So the thing was, we could already, before the pandemic, we could see the growth of this business. But as Stephen said earlier, the pandemic gave a turbo boost to a number of products. And Zoom is that. And I think it has changed how people are thinking about it. I mean, here up in Scotland, we used to think nothing about flying down to London for one meeting. Why do you need to do that now? We can speak over Zoom. So there are certain products that are changing people's habits, and I think Zoom is one of them.
Now we've focused in on some really well names there, really well known names there. Sorry, I'd like to home in, and most of them sort of across the Atlantic. So I'd like to home in on Europe and the UK. So a bit more sort of local talent, and Europe is not traditionally associated with sort of high growth names, but from what I understand, you're finding some really sort of innovative, transformative companies here. So do you want to tell me about some of the things you're finding here?
Yeah, I mean, it's a great example of why we're bottom up stock pickers or bond pickers rather than looking at the macro, because you're right. If you think about macro, you think of Europe as being a crisis and not much growth, and why do you want any money there? But actually, if you look at individual companies, there's a lot of excitement. So there's things like Spotify, for example, is a really world-leading kind of technology business. But there's one that I think is kind of perhaps more topical for everyone who's listening. It's a company called NIBE, N-I-B-E, which is a Swedish business, and they make heat pumps. Now, in Scandinavia, heat pumps are the norm, and they are one of the big players in that market. Now, as I'm sure you saw last week, there's all this talk about gas boilers in the UK getting phased out and so on, and everybody's saying, well, how are we going to pay for this and so on. But the key point is we're starting from virtually zero, and there's going to be a lot more heat pumps in the UK over the next 20 or 30 years, and NIBE is one of the big players in that market. Now that's exciting, and it's not just the UK. Think about America and other kind of cold countries that are going to have this as well. So I see that as a kind of fantastic long-term growth opportunity for a business like NIBE. Excellent. Now it's not just the Europe, Amy, it's the UK too. And I think as a UK fund manager, I get a little bit fed up with people saying, well, there's no exciting UK businesses. There's plenty of exciting businesses. Ironically enough, the best performing fund in the managed fund over the last 10 years is a British company, Ashted, which is the plant hire business. And I bet you nobody ever thought would think that, but that's been our best growth business over the last 10 years. But it's also businesses that are transforming, things like Marks and Spencer's, which, to be honest, Amy, I never thought I'd ever speak to publicly about owning Marks and Spencer's because we've never owned it for about 25 years. But we do think something really interesting is stirring there. They've got that JV with Ocado in the UK, which I think is allowing delivery of their great food business. and maybe, just maybe, they're turning that clothing business around. So that's potentially an exciting nascent growth business.
Wow. And then do you want to go into a little bit more detail about Ashtead? Over 10 years, you said it's been one of the best performing. What's been so
well,
great?
I mean, its main business is in the US, and it's plant hire, but it's not just plant hire. And what's really interesting is that what we saw was that, surprisingly, the American market was far less mature than, say, the UK in terms of companies renting rather than buying. But actually that's changing now. The Americans are now getting used to the fact it's more convenient to rent equipment than to buy. But what we've also liked about Ashtead is the fact that they're finding new markets. So, for example, they've been selling a lot of heating and ventilation equipment and floor cleaning equipment to a lot of these e-commerce businesses that need to have these big warehouses that have all the e-commerce. You need clean floors for lots of reasons. It's much cheaper to rent cleaning equipment than it is to buy it. So they've expanded markets that didn't exist, and that's really exciting. And that's a really important point about growth. It's not just in technology; it can be in other areas too. And you just need smart, motivated management to do that.
Now, Stephen, the topic of today's discussion is optimism. Very often we hear about risks in the market. We hear about things to be concerned about. We watch the news every day, and it's a car crash. So why don't fund managers want to talk about optimism?
Yeah, it's a really interesting one, Amy. I think there's just so much doom and gloom out there, isn't there? I mean, whether it's about the pandemic or it's about the risk of inflation or it's about climate change, and there just seems to be so much to worry about. I think you hit the nail on the head. Bad news sells, so that's what's in the news. That's what we see, and I think the reason why people pay more attention than they should to it is because it's a very short-term nature of how many people live their lives and how many investors operate. It's looking for the next thing to go wrong. And these things seem to be the most visible things on the horizon. And it's easy to worry about them if you think about what can go wrong. Whereas the way we think about it is we think about what can go right. And the only way you can do that properly is to have a really long horizon. You have to be looking beyond the next quarter, because those benefits of things going right, they just accrue and accumulate over quarter by quarter. It's very rarely dramatic, whereas the negative stuff can seem dramatic and very short, in the short term. But in the long term, we've seen from the managed funds history that we see dips in the market, we see various crises. The managed fund short-term dip, and then we're back up again. And it provided you hold the right investments through that, it comes back. And the lesson is that be optimistic actually works in the long run. But in the short run, if you're focused in the short run, it's really hard to do, and people will really struggle to do it. So we have a corporate structure that's a partnership that helps us to focus on the long term, because it's not always easy. It's something that we have to really work at. But I don't want to make light of the challenges that the world faces. These are big challenges, but for us, I think of that, these are opportunities, because these are opportunities for companies to meet these challenges, to help be the solutions to these problems that the world faces. So, that's what our big challenge is, to find those companies, find the ones that are developing the technologies that will be the solutions to these problems. And that's what we can do. That's how we can participate. So, one example that I like is Recursion Pharmaceuticals. It's in our US portfolio, and they're using machine learning to develop new models for drug discovery. And it's this early stage. It's a young company, but it could be transformational for the way that the drugs are developed. So really exciting, and it can really make a difference to how we recover from some of these issues that we face. So that's one I'd certainly be optimistic about. Iain's the equity guy, so he's got. I'm sure there's lots of other things that he's interested in or finds it optimistic.
Yeah, I mean, Amy, if you take Recursion, for example, I think the kind of key point of why we're optimists, and one thing I would say is one reason why most fund managers don't want to sound optimistic, because you sound like a lunatic when things look so bad and things like that. But I would say turn it around the other way and say, actually, the time to be really worried when there's nothing to be worried about, because then people are not really pricing in risk. And as Stephen said, it's to look for the opportunities. But the key thing is a term that we call asymmetry. And if you take Recursion, as Stephen said, it's an early stage business. it may not work. We will make mistakes. It may not turn out to be the case. So what is the worst what can happen here? Well, we can lose 100% of our money. Okay, now that sounds quite dramatic, but that's our known, that's the worst case scenario. But what happens if we're right? What happens if recursion really takes off? If the drug companies start using that product, you have unlimited upside. You can make multiples of your money potentially. And that's the kind of the key thing of why we're optimists, because if you're a pessimist, you lose 100%. If you're an optimist, you can make a multiple of your money. That's the asymmetry of returns that we talk about. So it's, and I think the other thing about optimism is you've got to accept you will fail. Let's say that there's a famous, American investor who said, rule one is don't lose money. Well, actually, we disagree with that. That actually sometimes you've got to be prepared to lose money, to find those really exceptional growth businesses that will make you a multiple of your money, and that will pay for more than all your mistakes that you've made.
And that is reflected, I suppose, in the diversity of the portfolio and how your asset allocation within it.
Yeah, I mean, a really important point for the managed fund is the balance within it. For example, in the equity bit of the portfolio, the diversity comes in two ways. One is we've given pots of money to each of our regional teams, and no region has more than about 20% of the fund. So we're very well broadly diversified by region. And then by stocks, we have over 200 stocks in the portfolio. The largest is about 1.5%. So there's not one stock that's dominating the performance. So therefore, people don't have to worry about if our biggest holding, is Shopify. It's a Canadian e-commerce business. If you read about the press that, it's say the shares have gone down overnight, it's not a big deal for the overall part of the fund. And we think that's really important for the managed fund client, that they know that we're not putting all our eggs in one basket.
Well, it certainly seems very zen in this side of the room. So let's see if we're now going to move on to our Q&A. So shall we see if any of our audience that's tuned in can rattle you? I've certainly got lots of questions come in. I've got a whole inbox here of plenty of questions. So let's not waste any time and try and get through them. Okay, so I'm sure this comes as no surprise to you. First question, how is climate change affecting your investment approach? Iain, do you want to tackle this one?
Yeah, I mean, it's as long-term investors, we've always taken a view that ESG is really important because, as Stephen said, if you're only worried about the next quarter, then you probably don't need to worry about it. But actually, if you're potentially owning a company for 5 to 10 years, which is what we do on average, then you've got to start thinking about these issues. The way we think about it, Amy, is ultimately we're trying to allocate our clients' capital to growth areas. And the best way to kind of highlight that is, if you go back 10 years ago, oil and gas accounted for about just over 12% of our fund. So it was a very big position. As of the end of September, it's 2.5% of our fund. So that's a huge drop. Now, why is that? Well, because we've been saying, well, actually, we don't see the growth in that area now. So we've been allocating our capital elsewhere. So actually, as fundamental bottom-up investors, we were using that the issues about climate transition to say, actually, this is not a growth area. So we've been moving money away from that area. So I don't know if that helps you in that's thinking about that point.
Yeah, definitely. I mean, a 10% drop in 2 years is pretty significant.
In a decade, sorry, not 2 years.
In a decade, right. It's still significant movement.
Yep.
Right, I'm going to pass this one on to you, Stephen. Do you have an investment trust which mirrors the managed fund, or is that what SMT does?
No, not exactly. The managed fund is unique. In terms of what it's doing and having that balance between the equities and the bonds and the cash. So our investment trusts that we do manage, including Scottish Mortgage, all have slightly different objectives and tend to be predominantly equities. So largely equity based, whereas the managed fund is definitely looking for that element of balance between the different asset classes. So it's different from the investment trusts.
A unique offering. You only get it here. Iain, admittedly very short term, but what are your thoughts on the recent volatility in the fund's performance, or can this one rattle you?
No, I mean, we just don't get worried about short-term volatility. I mean, what we're trying to do is to invest on a 5 to 10 year view, and short-term volatility is what it is. But the key thing is not reacting to it, in our view. So what we see as risk is permanent loss of capital. So if Mr. or Mrs. Market chooses to have a low price on some of our favourite stocks, and we think the fundamentals are still strong, we're not going to do anything. Why would you sell? So our view is actually almost the opposite. Is almost turn volatility to your advantage, and it's a chance to kind of potentially to add to holdings.
Okay.
I would just add, Amy, there that we do hold some cash in the fund, and that's one of the reasons why we hold cash, as well as helping to give some balance and diversity. It's for those opportunities when markets have perhaps corrected for short-term reasons, and if we think the fundamental outlook is still very attractive, then that's why we have the cash there, to use that cash to be able to buy into the market at those depressed prices. So I just wanted to add that in.
Certainly. Now, the next one, how do you ensure you avoid groupthink or institutional thinking? So, Baillie Gifford, is a house known for having very strong views. So, how do you can you tell us a little bit about operating there, and how you toe your own, whether or not you toe the line, and how that works in practice?
Well, I mean, it's a great question. I think the biggest way we have in terms of our culture is we don't have a kind of top-down sort of directing, you must think this, that people and teams are allowed to think whatever they want. So to take an example in the managed fund, although Stephen and I are the name managers, and you might say the head honchos, we don't tell our kind of very talented US colleagues what stocks to buy. So when we give our pot of money to the US kind of equity team to manage, we just say to them, you find the best ideas that you find. I'm not telling them, look, I need more technology, buy more technology. If they want to buy, something else in healthcare because they think that's the thing, because what we're trying to do is to tap into the expertise of our local experts. And we don't try and look at a consistent view across the fund. So, one region, for example, might be very positive on healthcare. Other areas might have very little in that. That's absolutely fine in my book, as long as they are finding the best ideas in their region. We do talk a lot, but ultimately we're each accountable for our own performance of our own area, and I think that's the best way to fight against groupthink, because ultimately you do what you think is right for your funds rather than what other people think. But I don't know, Stephen, you want to add anything from your perspective?
Yeah, it's an interesting one. I agree with all that, Iain. I suppose maybe to add as well, I mean, we do when we recruit our graduate recruitment, we look for really different, diverse sets of skills, different types of people who are we look for people who are curious about the world. So we look for that curiosity and individuality of thought. So that's helpful.
And how do you
challenge each other?
How do you test that? Is it like an interesting CV, or like a really enjoyable interview?
It's a combination of all those things, Amy. So you're looking at the CV in the background, you're interviewing and probing, asking questions, and seeing how these applicants respond. And we try our best to recruit people that we think are intellectually very curious and capable. But we're definitely after diversity. So diversity of thought, diversity of background are all really important to us. We're striving for that. It doesn't mean you can't still have the dangers of groupthink. You still have to guard against that, but that's one thing that we do. Another thing that we do is we have extensive networks of independent experts, if you like, or academics that we use as sounding boards to get ideas from. And academics are often very are challenging in what they're thinking and doing. And so we use that to help lead our thought. So rather than use the more typical of our industry sell-side research from investment banks and such, like we have a much bigger emphasis on independent thought in terms of where we get sounding boards from different people and ideas from.
It sounds like the trust.
If I could just add one thing, Amy, just on.
Yeah, go on.
Sorry, it was just on the recruiting thing. One of the things that we do that I'm involved in the recruiting is we do blind CV, so I don't see the CVs. So one of the sessions is actually, all I know is the person's name. I know nothing about them, and that's the kind of point you're trying to get them to. How do they think about things? Rather than I'm not sort of guided by where they've been to university or anything like that. It's just really how do they think, and that's a really important thing for us, because the partners in the firm are in charge of recruitment. Because other than actually investing our own money, that's probably the most important thing we do, is to pick the future leaders of the business.
Excellent. Okay, let's move on. What are your views on holding cash in a period of rising inflation versus investing in equities or bonds? So, Stephen, that's the inflation argument, unfortunately. But is this one you can you can succinctly answer?
I'll give quite a quick answer to that one. So, I mean, if there is higher inflation, then it's costlier to hold cash. Assuming that short-dated interest rates don't rise enough to compensate you, so it's probably more costly to hold cash. So that's a factor. We will bear that in mind. However, there still is that value to us of holding cash to use opportunistically if markets are overcorrected in a short-term basis, and we see long-term opportunities. We can use that cash, so it doesn't really change the overall thought process for us. We will still hold cash in the fund, but yeah, undoubtedly, the higher inflation is, the more we have to be careful not to hold too much cash. Yeah.
Okay. Right, Iain, back to you. Less macro, more again looking inside the culture of Baillie Gifford. And this particular viewer is interested to understand how the managed fund looks at the world differently to others at Baillie Gifford, say Scottish Mortgage, Edinburgh Worldwide, or Positive Change. And do you work together across the teams?
Yeah, well, I think the key difference between a lot of other funds is the fact that about 75% of the fund is in equities and the balance is in bonds and cash, whereas most of the other funds that you mentioned there are predominantly all equity funds. So that's one of the key differences. The other one is the fact that the managed fund is really based on the strength of our regional equity teams. That our UK team, our US team, our European team, our Asian and emerging market teams. That's the real strength of the managed fund over the last kind of 30 plus years. It's based on that. Some of the other funds that you mentioned there, they have a global team or a holistic team, and it's to be honest, it's an age-old debate about what's the best way to run it. Is it regional people who really know their markets, or is it the kind of global people who can look at things holistically? Both actually work, and that's the great thing about Baillie Gifford. We don't say it's one or the other; they both work. But certainly for the managed fund, we've been doing it this way for 34 years, and we think it works really well. And having that diversification and balance.
Okay, I think the next question is pretty straightforward. But Stephen, I'm going to pass over to you. Would you ever invest in anything other than bonds, equities, and cash?
No, we want to keep the managed fund simple and consistent. It's worked well for 34 years, and I think that's part of the secret of success. So, we've got lots of variety within those. So within equities, you've got a huge amount of things that you can invest in, and within bonds too. There's a lot of different types of bonds. It's not all a UK gilt. There's just so much you can invest in, different types of bonds and so forth. So actually, we've got loads of flexibility. And so that's not something that we have been, we are going to change at all, no.
Very straightforward. 34 years and going strong with the same process. Now, this one is all about scale. So now at over $9 billion of AUM, is there a limit to the size of the fund?
No.
The sky is the limit.
I wouldn't say the sky, but we think we can certainly grow it significantly from here.
Mm-hmm. Stephen, anything to add?
No, I would agree with you. We've talked about it, but because we have the diversity of lots of different, all our regional equity teams, then it's not a concentrated equity portfolio where you might run into more problems. It's very diversified, lots of different stocks, and that gives us the opportunity to still grow quite a lot. Yeah.
Fabulous. All new investments welcome. Right. I think we are. Let me double check. Let me double check. I'm getting to a single page of questions here. Let me scroll down. Oh, right, here we are. Has the regulatory crackdown in China, oh wow, we're going macro here. Has the regulatory crackdown in China impacted your investment thesis on equity holdings? Okay. I suppose, Iain, this is your territory.
Oh, I thought you were going to ask Stephen there. It's an interesting one.
Okay there.
Yes, yeah, I can hear you fine, unfortunately. I think in one sense, we're not too worried by it. In some ways, it's kind of quite healthy that what the Chinese authorities are trying to do, which is to make sure that things are not too uncompetitive or anti-competitive. And actually, some of the companies that we own that have actually had fines, actually the shares have actually gone up after the fines have been announced. So the sense of the market is saying, well, actually, that's not too bad. So we've got to keep watching what's going on in China. There is a lot of politics going on, I think. The president is up for re-election next year, effectively, not a election as we would call it, but certainly an election. So there's stuff kind of going on there that we're probably not that privy to. But if you step back and see what the Chinese government have done over the long term, they've actually done an excellent job in a lot of ways in terms of kind of promoting growth and taking 1 billion people out of poverty. That's a tremendous achievement. Whatever else you can say about them, that's something that very few people can credibly boast about. But they've done that. So and we still see China having a lot of potential for growth. And there's some very innovative companies in China, and that's why we have investments there.
I mean, again, that is something to be optimistic about, because China, it does get it is getting a hard time. So, but it can't be ignored. It's the second largest and soon to be the largest economy in the world. So these are important things to not take for granted quite how much progress has already been made.
Absolutely. I mean, again, it's classic. If you focus too much on the macro, you're perhaps missing what's going on in the micro. And a couple of things. The innovation that is going on in China is quite incredible, and the growth potential of that market. I mean, I don't know if you've ever been out there, Amy. It's quite staggering to see the size of some of these cities that, frankly, you and I probably can't even name or put it on the map. But they're bigger than London. And that's the sort of thing that you've got to get your head around when you're investing in China. That the growth opportunity and the fact that the Chinese consumer is looking for, they've jumped, they've grasped the internet very quickly. Now they're still saying in the US we've still got great potential. In the US, retail sales are still only 15% of it is online, but in China it's moving faster, and that is on one hand exciting, but also frightening for the incumbents. But we're trying to be on the right side of history by investing in the companies that are disrupting, that are trying to find new markets. And that's, when you look at a lot of our holdings in China, that's what we're owning. It's not the kind of the big monoliths. It's the kind of the exciting e-commerce businesses, which we think have got great growth potential.
Excellent. Okay, well, that was quite a hard one. So we're in the last few minutes, I'm going to close on the final question. What excites you both most about your role when you get up in the morning? Stephen.
I just love the fact that it's different every day, and there's something happening in the global economy and opportunities to invest in different companies, different countries when it's in terms of their bonds. So there's challenges, and we have to continually try and think through how these challenges might play out, think how the world is going to develop in the future. We are that's what our job is here. It's predicting how the world is going to change. We are trying to be different from the index. The index represents the past, the successful companies of the past. We are looking to the future and which companies are going to be the disruptors. We're in the bond market. Do we see real value? So I just love the fact that it's different, it's changing, it's huge challenges, but extremely exciting.
And Iain.
He's still all the good lines as normal. I mean, I like the fact that we're trying to allocate capital to businesses that are growing. And ultimately, we think we can try and help people by investing in businesses that can grow over time. And that's a kind of great job. You're trying to help people, because the beauty of active management is if you can actually add value, it makes a big difference over the long term. And the fact that, the fund is outperformed by, I can't remember, just over 2.5% above net of fees over 34 years. It doesn't sound a lot, but when you do the compounding of that, it's really life changing. So it's that responsibility. It's quite, in some ways, it's quite awesome, but it's also very exciting in the sense that you think we can actually do a good job for our clients, because ultimately that's what matters. It's doing a great job for our clients.
Is that when you say life changing, it's that somebody who's been with you on that journey. What can they do with that capital? How can they put their children through school? Is that that is a sizable pot if they've gone on the journey a long time ago.
Exactly, and I think that's the thing about active management, and also active management at a low fee, is that makes a difference to people. Because it's interesting, Amy, if you look at our fund sector, we're one of the lowest cost funds in that sector, despite the fact that we're one of the top performing ones. And that's kind of, unfortunately, that's unusual in our industry, that people sort of expect high performance means high fees. Well, we don't believe that, because we think ultimately if clients are getting a great, hopefully, return and they're not paying outrageous fees for it, they want to stick around. And that's good for us too. Let's not kid ourselves. But actually, that's a kind of classic win-win, I'd have thought.
Excellent. Okay, well, very good value, lots of capacity, and plenty of new ideas. So the good news from the Baillie Gifford Managed Fund. Right, thank you both. That's all we've got time for now. Thank you. We've had plenty of questions. Thank you, Iain and Stephen. Thank you both for your time and your insights. And thank you all for watching and for your questions. We've got more programs coming up, so do keep an eye out on those if you found today useful. So goodbye from all of us, and happy investing.